And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
Good morning and welcome to the second best day of the week. That's right, it's Thursday. It's the Real Investment Show. Thanks for joining us this morning. Michael Lebowitz will be joining me here in a few minutes to talk about the Fed yesterday, of course, hiking another 75 basis points and, then uttering the magic words, apparently, because the market surged. NASDAQ over 4% yesterday. The S&P 500 breaking above 4,000 now. That is actually starting to push the market back into very bullish territory. And again, we continue to watch this very bullish trend that we've been talking about now for the last several weeks, and this has continued to go on. We talked about over the last 2 days that we needed a successful retest. We retested the 50-day moving average yesterday. We said, well, what we need is a follow-through day that gets us above these previous tops. Exactly what happened yesterday. Big surge day after the Fed announcement. And so this has now put the market into a pain trade situation. Too many investment managers, too short equities, markets going up, fear of underperformance. And as I've said before here on the show, it's no longer the fear of missing out on the rally. It's the fear of missing out on the bottom when the Fed pivots. So we'll talk about that this morning as well. But also, too, other news kind of moving markets this morning. Yesterday, Senator Manchin has come to an agreement with Chuck Schumer over a potential new spending bill for the economy. Now, this is going to be somewhere around $400 billion for this bill, and it'll be paid out over 10 years. So it's about $40 billion of investment over 10 years. But part of that is to be paid for by putting a minimum tax on companies over $1 million of 15%. So that's going to impact a lot of businesses around the country because there's a lot of companies that are over $1 million. So, but again, this corporate minimum income tax is something that is going to be kind of heavily debated here over the course of the next several weeks, particularly as we move into midterms. Hiking taxes on businesses probably isn't a great idea just prior to a midterm. We'll see how this goes, but with Manchin's support, now very interesting to remember, Senator Joe Manchin was very much against the Build Back Better plan previously. Says too much debt, too much deficits, this is all going to be passed on to our kids. He had become kind of a conservative hero, right? Despite the fact that he's a Democrat senator, he actually became a hero of the conservatives, at least for a while here. Now kind of backing off that stance a bit. Don't know why. He hasn't really given any reasons. But instead of the Build Back Better plan being this $3 trillion plan kind of shoved down the throats of Americans, it's now going to be spoon-fed to you $400 billion at a time. So we'll see how this works out. But again, that's more government spending. And what's interesting is more government spending, which is what got us into this inflation mess to start with, is now called the inflation fighting plan. So this is going to be the idea that the government can spend money to lower prescription drug benefits and those type of things. Don't know exactly how that's going to do that. Fund the Affordable Care Act, which is very inflationary in the overall economy because it's a very expensive plan. And also, too, funding clean energy initiatives, which are also inflationary. So all of this is very inflationary in its very form. But again, government spending in and of itself, as we have seen, is also inflationary. So again, while they're hoping that this will help quell some inflation, and it'll actually work out because, right, they're going to spend this money at a time where inflation is already going to start to peak on a year-over-year basis. So they can say, yeah, see, look, it's bringing down inflation, but really it'll have nothing to do with that. It'll be a function of math and how math works over time. But besides that, again, earnings still coming out. Earnings season has been very supportive for stocks because earnings are not as bad as expected. We saw this with Microsoft and Google just recently. We also just saw it here with Netflix, talking about, well, they only lost 1 million subscribers versus 2 million. So again, not as bad as expected, and that's giving a little bit of lift here to stocks as well as markets continue to try to drag up off these recent lows and put a more lasting bottom in for the markets. This morning, a very interesting kind of note, Comcast reporting earnings, talking about this is one of their best quarters ever on record, right, for subscriptions, because again, what they're seeing on a year-over-year basis, and they're saying, look, subscriber growth is basically flat on a year-over-year basis, one of the best quarter twos they've had. But that's because of the pull forward of pandemic. But here's what's interesting about this. Remember that whole thing a few years ago about cutting the cord and getting rid of cable? Well, apparently people are cutting the cord and they're getting rid of subscription services and going back to cable because all these subscription services all added up to be a lot more than your cable bundle, which is what actually happened. Again, now that through Comcast, you subscribe to Comcast, get most of your programs bundled into one price that you want, it's actually turning out better and cheaper than all these other subscriptions that you get. So again, Comcast reporting earnings. Now the stock's going to be down a little bit this morning, but actually beat on revenue and estimates. Again, kind of this market is still starting to kind of pick through some of these forward guidances and kind of what's trying to price in impact of growth. So stock will be down a little bit this morning, but again, this is a kind of showing this transition within the economy as well. People are starting to focus on where they're spending money and making choices here to migrate to places where they can save more money and still get the services that they want. And this is just simply a function of where we are economically. So again, looking back to the market here real quick this morning, markets did break above those tops yesterday. So we now have broken above overhead resistance. This is good news. As we talked about yesterday, that puts into target these previous tops that we had here back in early June. That's right around 4150, 4160 on the S&P 500. So again, still some decent upside here over the course of the next few days, next week or so. So again, it looks like the market's going to try to push higher here. Now, historically, though, after the fourth Fed rate hike, and we're going to talk some more about this in this weekend's newsletter, it's also in today's commentary that's on the website right now at realinvestmentadvice.com. I just posted a few minutes ago. Simply go by the website, click on the daily commentary link right there on the homepage. Get today's daily commentary, which is talking about the fact that after the fourth Fed rate hike, and again, one of the interesting things here, Fed talking about potentially a pause at some point, that has typically been just prior to the recession. So we talk about recessionary trends within the economy, talking about a lot of this economic data showing potential for a recession. And this is about where the market or the Fed normally pauses just before the recession starts, then they start cutting rates. So this is all kind of playing out very much to history and what we would expect. Now remember also that while stocks may rally here for a while, and it could be a very strong rally as we've talked about before, too many people off sides, too many portfolio managers, short equity, fear of missing out on the rally. The issue is that when the recession actually sets in, and that tends to be about another 6 to 8 months from where we are currently, then that's where markets, again, decline and begin to reprice valuations. So again, just something to pay attention to as we go forward. Again, very bullish action here short term. Upside is probably where markets are going to short term, at least on a technical basis. Pain trade here is higher, but again, got to look forward to as well as to what's going on economically and how that's going to feed in to the markets and the economy. Okay, quick break. We'll come back. Got a lot of stuff to get into with the Fed yesterday, what they said, what they didn't say, what the market heard, what the market should have heard. All that coming up with Michael Lebowitz here in just a moment, right here on the Real Investment Show. Get by the website, as I said, get our daily commentary. That's out this morning, realinvestmentadvice.com. Be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Inflation touches every aspect of your life. No one can avoid it because we're living in an inflation nation. RIA Advisors has a 9-step inflation battle plan, and we're sharing it with you in a special summer lunch and learn Thursday, August 4th at noon. Register now at realinvestmentadvice.com. There's no magic elixir against inflation. Our 9-step plan can help you blunt inflation's effects. Register today at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
Could your job still be at risk? A new normal can still include new obstacles. A severance package can be an emotional as well as a financial decision to consider. Wouldn't it be comforting to review the options for you and your family with an objective financial partner? At RIA Advisors, we're here to help. From severance pay, tax timing decisions to how to maximize unemployment benefits, the RIA team wants to make sure you can do what's best for your family. There's no charge for a consultation, so reach out to RIA Advisors, 855-RIA-PLAN, RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. It is 6:17. Michael Lebowitz joining me this morning. Just to, kind of just hit a highlight here for a moment. Headline this morning, it's up on the Hill. Let's say, actually, that's not this morning. It's yesterday. Yesterday, very late 11:37 p.m. Eastern time last night. Headline on the Hill this morning reads, Pelosi's husband sells off $5 million worth of chipmaker stock ahead of semiconductor bill vote. This is interesting because, they just bought they bought $8 million worth of options on NVIDIA here because of the semiconductor bill passage. Of course, that stock had a huge rally yesterday, and it actually has been rallying for a couple of days because of this idea that there's going to be this $52 billion package passed to help support semiconductor development here in the United States, right? Kind of bring home manufacturing. But there's also another $200 billion for long-term research and development on top of that as well. So it's a big bill. What's interesting is now it's become an open joke kind of in the financial markets that if you want to trade your portfolio, just follow what Nancy Pelosi does. Now, this is insider trading, pure and simple. She has inside information about what the government is going to do. And of course, she's selling off, stock on semiconductor bill. Maybe the bill's not going to pass now, right? Maybe this is the headline vote. But it's become an open joke that, Congress inside trades. Now, we don't have this capability. If Mike and I went out and we knew that Congress was about to pass a bill and we went and bought a bunch of stock, or if we knew something inside information of the company, right? NVIDIA is about to come out with boomer earnings, right? We're the only people that have it. Mike and I go buy a bunch of stock. That's called insider trading because I'm trading on information that is material and non-public, right? And by doing that, I will have a couple of penalties for that. Namely, I'll have to give back my gains, right? So that'll be the first part of it. Second part of it is I'll probably pay a very hefty fine of it and go to jail. As has happened before. You might remember Martha Stewart actually went to prison. I don't know if you can call it, Club Fed, where she went She looked good in an orange jumpsuit, by the way. But she went to Club Fed and, spent some time there because of insider trading. And her insider trading was negligibly insider trading. There wasn't real clear evidence and really across the board that she, was insider trading. But she got nails for it anyway and went to jail. Okay. But Nancy Pelosi is an open joke now among the financial markets. I mean, there's whole memes dedicated to Nancy Pelosi and insider trading. And it's okay because she's in Congress. Okay, I got that rant off my chest this morning. Michael,
well, I think
welcome to the show
what
this morning.
Lance is, she's actually flaunting it.
Yeah.
Right? This has been in the press, the media for over a year now about how she's doing this.
Uh-huh.
And then she buys NVIDIA, and next thing you know, there's a big semiconductor bill on the Hill.
Yeah. Well, and look, we just went through an investigation with two of the Federal Reserve members that were buying and selling and liquidating securities ahead of, potential changes to Fed policy. And of course, there was a big hubbub on that. And there was of course, the big Federal Reserve investigated these Fed members and then, of course, found no wrongdoing at all. They're completely fine. But, it's just become kind of an open reality now for the individual kind of investor that the game's rigged. I mean, if you're either super wealthy on Wall Street or you're in Congress or some position of the Fed, it's completely okay for you to inside trade. I mean, this is a very simple fix, Mike. All we have to do is say, look, if you're in a position in the government, in the Federal Reserve, and this happens at a lot of kind of Wall Street firms as well. If you're in one of these positions where you have regular dated access to inside information, you can only invest your money in U.S. Treasuries. You shouldn't be allowed to invest in the stock market if you have this material inside information. They go, well, we could put it into a blind trust, and the trust manager is going to make those decisions, and you won't have access. But all you got to do is call the trust manager up and say, hey, Mike, you're my trust manager. Mike, don't tell anybody, but go buy a bunch of NVIDIA for me, right? So it's just, you've got it. It's a very simple fix. Look, if you're in a position of power or authority, you put your money into treasuries while you're in office. And when you come out of office, do whatever you want. But while you're in office, you can't invest in the stock market. And it seems like a pretty easy fix to me.
Someone once told me that if you want to know why anything in this world happens, it's because of money.
Yeah, exactly.
That's why.
Yeah, no, it is. It is absolutely that. Okay. All right. Rant's over for the morning. Maybe, possibly. I may rant again once we get into talking about the Fed here. So all right, quick update from yesterday. Obviously, the big news, as I was talking about this morning, the Federal Reserve came out yesterday, and basically, they hiked rates 75 basis points, exactly was expected. Two of the interesting notes, I guess, out of the meeting, and again, there was really not much of a change to the meeting. There was a couple of small little word tweaks, and we'll get into those here in a second. But probably two of the most significant, I guess, changes was, one, the Fed decided to stop giving forward guidance. Now, what does that mean? So forward guidance is where they'd say, we're monitoring employment. Employment looks good here. It's strong, but we're monitoring it, and we're focused on inflation right now, and kind of in giving these kind of guidances that, the next meeting they're going to continue to hike rates at 50 basis points or 75 basis points or whatever. And so the markets have been trading off this forward guidance. And so it's been picking up a lot of volatility in the markets. And so now the Fed's saying, well, we're not going to give you the forward guidance to trade off of. So I'm not sure if that's good or bad. We'll find out how the markets react to that. The only other, kind of interesting news, Mike, was, the shift in focus on inflation. I thought, as you and I kind of discussed yesterday after the meeting, he kind of tailored the inflation focus kind of away from their normal kind of PCE and energy focus on inflation to food prices. Thought that was kind of an interesting shift.
He also, during his press conference, focused a little bit more on CPI versus PCE, which CPI tends to run a little higher than PCE. Mm-hmm. The Fed likes PCE. Even during the meeting, he said they prefer PCE, but he did say that CPI is what consumers pay and that they're paying a lot more attention to that. And they, like you said, Lance, in this Fed statement, so what they do is they revise the Fed statement. They take last the last meeting Fed statement, and they change, anywhere from 5 words to 30 words. And in our daily commentary today, we provide a red line edition where we show what it did say and what it does say. And one of the interesting things was the last statement, it said something to the effect that higher energy prices are one of the inflation problems. This time he said food and energy prices. So he's clear. So he's clearly getting at is how inflation affects the consumer. And, I think some of that has to do with the upcoming elections. But it is showing that they do, I think for the first time, this isn't just a theoretical textbook inflation, and we're not going to count food and energy or any of the things that we use in life. Mm-hmm. We're just going to use our model inflation, our PCE inflation, excluding food and energy. Now I think there's finally some admittance that food and energy prices are a big problem, and it's what we spend a lot of our money on.
Yeah, and I guess the question though is and I guess as we're talking about inflation, of course, the inflation focus, and again, when the Fed looks at inflation, they look at PCE and they look at specifically trimmed median PCE.
Right.
The question is, by changing their focus onto food prices, which tend to be a little bit more sticky. I mean, once you start getting inflation into food prices, it tends to be a little bit more sticky than kind of a broader measure of inflation. And that may actually push them into, another corner, which is if they're focusing on food and energy prices now, and instead of stripping those out and discounting those to a degree because of normal volatility, now they may be focusing on inflation that, even though we see inflation coming down economically, they keep saying, well, no, inflation's too high, and so they keep hiking rates. And again, the problem is they keep hiking rates until they break something. That's the big risk, right? So, will this kind of shift in inflation focus cause them problems down the road of being overly aggressive in terms of hiking interest rates, and they cause other problems in the economy?
Right, and it may trip them up even this time if we get, droughts or we get a hurricane that affects crude prices. I mean, all kinds of non-typical demand things can happen to the supply of food and energy that can cause them to shoot much higher or drop significantly. So there's the reason they don't like food and energy in their inflation numbers, because they are volatile, and they can go up a lot, they can go down a lot. But now they're starting to tie their boat to volatility in food and energy. So they may be thinking that, well, look, food and energy prices have started coming down. Maybe if we tell everyone that that's what we care about now, they'll think that inflation is coming down. But they can just as easily go up. And like we've seen crude oil hit about $90 a barrel. It's back closer to 100. So, that's a 10% rise, which will eventually work its way into the inflation numbers again.
Right. Well, and again, this is going to be interesting. Now, when we come back from the break, I want to talk, kind of shift the focus and talk specifically. The Fed, the market liked the Fed announcement yesterday. After the Fed meeting, of course, they came out. They announced the 75 basis point hike. Chairman Powell starts having his conference. He utters about 3 little words, and the market goes off on a rampant tear. NASDAQ finishing up 4% today, 4% yesterday. On this idea, futures are kind of flattish this morning, holding on to those gains. So, what did he say, and what did it mean, and what typically happens from here? So we'll come back and talk about the pain trade. Come back after the break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Inflation touches every aspect of your life. No one can avoid it because we're living in an inflation nation. RIA Advisors has a 9-step inflation battle plan, and we're sharing it with you in a special summer lunch and learn Thursday, August 4th at noon. Register now at realinvestmentadvice.com. There's no magic elixir against inflation. Our 9-step plan can help you blunt inflation's effects. Register today at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
So my daughter moved out of the house yesterday. I think she's going to be president.
How's that?
She's moving out, and we're trying to move our house. And so I told my son and daughter, I said, look, before y'all leave the house, I want all this stuff moved out to the garage. And they're like, okay.
The Real Investment Show podcast.
In about 30 minutes, she comes back with like 4 friends. She suckered these 4 other kids into moving all the trash out to the garage while she stood there and directed.
At realinvestmentadvice.com.
She's going to dominate the world.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
Have market gyrations caused you to lose sleep? If so, it's because you have more risk in your portfolio than you realize. It's time to reevaluate your long-term investing strategy with RIA Advisors. Our disciplined approach can help eliminate unnecessary risk. If you think it's time to work with an advisor who puts your interests first, it's time for Real Investment Advice. RIAadvisors.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. I'm your host, Lance Roberts. Mike Lebowitz joining me this morning. So the pain trade is higher, at least momentarily, as stocks rallied sharply yesterday following the Fed meeting. And it was interesting because, before the meeting, everybody was kind of questioning, what was the Fed going to say? Everybody was kind of taking odds. The markets were very split. And of course, one camp says, well, if they stop, if they talk about a pivot, then that's going to be terrible for stocks because that means that they're no longer focused on inflation and, that's going to send everything kind of in a tumble. And then the other side of the camp said, well, if they hike rates, then that's bad for stocks because they're hiking rates and that's tightening policy. And that's going to be bad for the economy. So the market very split onto what the outcome was and what the situation would be. But again, as we talked about earlier, the kind of shock news yesterday, I guess, for the markets was 2 things. First and foremost was that, as noted, he said that they're going to start to pull forward guidance. So they'll no longer provide that forward guidance for the markets to trade on. But then also he said in one sentence, and this is what sent the market screaming higher, pace of rate hikes to depend on incoming data, which the markets took to mean as a more dovish tilt that if inflation data comes in, starts to get weaker, if we start to see economic growth stabilizing, et cetera, then that means that the Fed will likely pause their rate hikes sooner rather than later. And of course, that means that if they're going to pause their rate hikes, the next thing to come up is rate cuts, and you need to buy stocks. So everybody, fear of missing out. And of course, with everybody on the wrong side of the trade, fund managers, extremely light equity exposure. Consumers have a very negative outlook for equities. That is typically a bullish sign when everybody is negative. Investor sentiment is very negative across the board. Technical indicators are negative across the board. So again, when you start to look at all these factors, you have this situation set up for a reversal in the markets. And this is the so-called pain trade, which is now short fund managers are having to deal with this morning and yesterday, and it's not a very good place to be in. So with that, Mike, welcome to the show back. Well, actually, welcome back to the show. Thank you so much. And so, yeah, your takeaway from the meeting yesterday is first of all, just kind of your general observation.
Well, so the Fed statement came out, and I read that statement without looking at markets or reading any commentary. And the statement read to me very similar to the prior statement. Listening to Powell speak, his tone is really not changing. I think the market, and a couple days ago, Microsoft and Google had earnings. Both were less than expected. Both rallied pretty sharply on that bad news wasn't as bad as it should have been. So the market coming into the meeting was sort of in bullish mode. You know, the $1 million question is the bottom in, or is this just a bear market bounce, reflexive rally, and to work off some oversold conditions? But the market came in wanting to hear good news. So the market heard what it wanted to hear, that the Fed is closer to the end game than it was when it started. But that's obvious, right? Every time the Fed does something, they're getting closer to the point they're stopping. I think what really drove the market was when he said, we're going to take rate hikes meeting by meeting. We're going to be data dependent. Data dependent means a whole lot of things. It means they're still looking at inflation and that they will just keep raising rates. It means that they're going to start focusing on employment more. So if the unemployment claims keep rising, maybe they'll back off a little. But he really didn't say anything, both in his speech and in a statement, that changed what we knew 2 weeks ago. Now, to me, there were kind of two things worth paying attention to, the stock market and the bond market. So the stock market had a really nice rally yesterday. The bond market was up before the meeting, and it gave back its gains. It closed slightly lower, but it didn't get destroyed. This morning, bond yields are rising. So if you kind of look at the combination of stock and bond markets, the bond market's starting to whisper. It's not yelling, but it's whispering, Fed, you better keep paying attention to inflation. And the stock market saying, you know what, they're getting closer to the end game. They're going to pivot. They're going to be dropping rates. So I think over the next few months, the question that we're all going to have to answer is, we all know the Fed's going to get to a point and they're going to stall. Right? Whether that's 3%, 3.5% or more, that's debatable. The question is going to be, how long are they going to stall before they truly pivot and lower rates? And you can go back and look through history. That period can range from very short to well over a year. So a lot of this is dependent on inflation and on the economy. Tough part with inflation, especially CPI, is it's going to be hard for it to materially drop over the next few months, not because of what's happening today, but because of what happened a year ago. And you have some very low numbers that are still in the CPI calculation. Mm-hmm. So there's 12 months worth of CPI numbers. And when we go back and we look at a year ago, when we go back and look at August, that was a low number. We're going to be stripping out a low number from the average and adding a higher number. So just that combination raises the year-over-year CPI rate. So over the next few months, it's going to be tough for CPI year-over-year to become materially down. But the month-over-month number, I think, is the one that will garner the market's attention. And if we start seeing month-over-month changes of 0.3, 0.4, which you can do the math, if you annualize that, you get to 3.6, 4.8%. That may make the Fed feel a little better, may make the market feel a little better, and we can get some more juice out of this rally. But to me, I guess the question is this a bounce or is this the real thing? And you can't discount either one. The fear of missing out is very strong, and even if this is a bounce, it can be a very significant bounce.
Right. Well, and again, kind of it was interesting because as we were kind of watching the Fed meeting, kind of unfold, and of course, then I had spoken just before he started the presser, and then once he was in the presser, he says, these rate hikes are going to be, depend on incoming data. But then he kind of confirmed that it'd be likely appropriate to slow increases at some point. And again, that's also, kind of a known, right? I mean, they just can't keep hiking at 75 basis points forever. They've got to, at some point, they're going to stop or slow down or be reduced. So it seems kind of logical that, yes, at some point, Fed's obviously going to slow down the rate of rate hikes. But the market kind of took this as the second coming of Christ and all of a sudden started jumping in. But again, the problem is that there's so many managers that are very short equities or just simply underweight equities to a large degree. And, this really comes down to a matter of performance. By the end of the year, they can't have a big underperformance of equities. And so they've got to, they've got all this cash there, sitting on their books that they've got to get invested. And again, a lot of retail investors have been, again, I've never seen this has been a very interesting kind of bear market that we've been in, even though we're not in a bear market. We're still in a correction. It's been interesting because normally when you have 6 months worth of just kind of drubbing in stocks, investors really don't want much to do with stocks. But this time around, it's like, well, when do I buy? When's the time to put money in? I don't want to miss the bottom. As we've talked about before, it's no longer a fear of missing out on the rally. It's a fear of missing out on the bottom. And that's going to be kind of the interesting change because, again, the Fed has trained individual investors now for 12 years to, buy the dip. And, if the Fed's going to pivot and start to, potentially stop hiking rates, which also means that if they stop hiking rates, the next leg is going to be reducing rates again, then I certainly want to be in advance of that, in terms of the stock side. And so we saw a lot of move back into risk assets yesterday, a lot of the beaten down stocks, kind of the ARC type stocks we've talked about before here on the show, Block, Shopify. Shopify had terrible earnings. Stock was up almost 7% yesterday. So, it was just, this immediate kind of rush back into those high risk assets that, potentially can make the biggest gains in the shortest amount of time.
And I think what's interesting, and some Fed members have said this, that it kind of between the lines, but they're comfortable. They have been comfortable with the stock market decline, taking some of the froth out of the market, bringing valuations back a little bit more towards normal levels, and there is a disinflationary effect as stock prices go down. Wealth drops. Mm-hmm. So as stock prices start rising, the Fed, that becomes a little bit of an inflationary tailwind. So that's another thing that I think the Fed liked interest rates going up and they like stocks going down. And they like them going up and down in orderly fashion. But, interest rates have come down yesterday, so that does less to slow demand up. And stock prices have been rising lately. Not a ton, but they are rising, which adds to the wealth effect. Mm. So it's kind of an interesting conundrum. The Fed, I don't think the Fed really put themselves in these shoes, but investors are putting the Fed in those shoes.
Right. Well, and again, the Fed has to also realize that, at some point, these kind of open, pushes into the markets, monetary liquidity, et cetera. And it is interesting, the market's rallying. The Fed's still hiking interest rates by 75 basis points. They're still tightening their balance sheet. There was no real discussion about all of a sudden they're going to reduce their quantitative tightening and start to go back into quantitative easing, which is what actually puts fuel into the markets. Despite that, the market's already gearing up for this change is already going to occur. We're going to go back to the accommodative era. And, I've got to be long risk assets. And it's just kind of an interesting psychology that's been built into the markets. But yet the Fed really hasn't changed, their tone, and we'll see what happens. Again, the big risk is a recession, and what happens to earnings growth there. So we'll talk about that some more. We'll talk about earnings and earnings growth when we come back from break. Lots of earnings today. Apple and Amazon report today as well. Don't go away. Be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Inflation touches every aspect of your life. No one can avoid it because we're living in an inflation nation. RIA Advisors has a 9-step inflation battle plan, and we're sharing it with you in a special summer lunch and learn Thursday, August 4th at noon. Register now at realinvestmentadvice.com. There's no magic elixir against inflation. Our 9-step plan can help you blunt inflation's effects. Register today at realinvestmentadvice.com. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So as I said just before the break, earnings are coming in fast and furious. Over the rest of this week and next week, we're going to have about 80% of the S&P 500 reporting earnings. And if you download our daily update, if you subscribe to it, if you go to our website, realinvestmentadvice.com, subscribe to our daily update, we post a list every morning of what stocks are going to be reporting earnings before and after the bell, estimates, those type of things. So that's there. So simply just go to the website, realinvestmentadvice.com. Just click on the daily commentary link right there on the homepage. And, and the daily commentary will come up. You can read it. And on the right-hand side is a banner. You can subscribe to it. And it's a free email every morning. Comes right to your inbox. And so you can join the thousands of other readers that read it every morning and get their investing day prepped and ready to go. But this morning, or today, I should say, both pre-bell and post-bell, got a lot more earnings coming in. Big companies reporting today, Apple, Amazon in particular. Apple's going to be one to watch. That's a, kind of a consumer, even though it's in the technology space, it's really more of a consumer. I'm going to put it in the consumer staple place because I don't know anybody that can't live without their damn phone anymore. So, it's like, gotta have your phone. Mike, what kind of phone you got in front of you right there?
An Apple.
Then Apple.
What
see,
else?
Exactly. What else? What do you mean?
You're
what
the
else?
only one with. You're the only one with the what else?
I am not either. Brent Clanton over here has a Samsung. Anyway, Android actually has more cell phones out there than Apple. Anyway,
hi, this is Charlie K. Down.
Anyway, I don't know why.
The problem is once you get one, it's hard to switch because of all the apps and all the stuff you accumulate on your phone.
I know.
That's right. Yeah,
it's true. But they're more of a consumer. I really, like I said, even though they're a technology stock and technically they kind of sit in the technology space. It's really more of a consumer staple than anything else because, again, people just have to have it. Amazon's going to be the other interesting side of this because that's on the consumer discretionary side. So, again, this is going to be kind of an interesting set of announcements coming out today. Can I live without my Apple phone, right? So what do consumers say about Apple in terms of earnings? Are their earnings growth staying, relatively consistent? Are people upgrading their phones? Are they buying the new phones? Are they downloading the apps, subscribing to Apple Music, all the things that Apple does that people just literally can't live without, versus Amazon, where that's more consumer discretionary. It's hard not to shop on Amazon, but as we just saw with Walmart said two very kind of interesting things. One, it's been an inventory challenge for Walmart, Target, and also Amazon. Amazon has also noted they have too many employees, too much inventory. But the other notable thing that Walmart said, and a lot of the media really kind of blew over it, and a lot of people blame management for their inventory problem. But what Walmart said that was more important is they said that foot traffic was a lot slower in stores because consumers are having to make decisions over purchasing stuff inside of Walmart versus paying for food and gas. So it'll be interesting to see if people are starting to slow consumption on the discretionary side for Amazon. Now, interestingly enough, while it seems like Amazon dominates the world, and if I ask you a question, and Mike, let me ask you a question, and you're going to know the answer to this. Well, actually, let me ask Brent here because Brent may be a better guy to ask. Who is, and actually Brent knows the answer to this one, but if you just as an average person, right, and I said, what's the largest retailer in the world, what would you probably say?
I would probably say Walmart, even if I hadn't looked
at the graphic.
Yeah, that I gave you yesterday, but that does not surprise me.
Yeah. But, but you think about it, though. I mean, all people talk about it is like every day, my wife has 12 packages arriving from Amazon.
Right.
My dogs are best friends with the Amazon delivery driver, right? It's just.
Well, I comparison shop between Amazon and Walmart, depending upon what's available and the best price.
Yeah, my wife doesn't.
Yeah.
She's
I'm so sorry.
She's an Amazon girl.
Plus, there's the entertainment.
And it's an Amazon world.
Yeah, and there's the entertainment value at Walmart.
At 2 o'clock in the morning, particularly, yes. But yeah, so, if you kind of think about this, Walmart is twice the size of Amazon, which is really kind of amazing if you think about it. But, these are going to be two very important reports about the consumer today. And it'll be interesting to see how the market responds to that. But also today we got Pfizer. Honeywell just reported better than expected earnings. Got MasterCard. Visa had better than expected earnings 2 days ago. Visa said basically consumer spending remains very strong. Not surprisingly, though, because people are having to resort to credit cards. It's kind of a conundrum because, again, individuals are having to make choices about where they spend money. But they also have run out of savings, and so now they're having to spend on a credit card. So Visa is saying, hey, our credit card transactions are great. Yeah, because people are having to go more into debt to make ends meet. But again, outside of that, also energy companies reporting today, Valero Energy, and oil companies are expected to post record profits again, not surprising with near $100 a barrel oil. So again, this is all kind of feeding into, this market dynamic that Mike and I were talking about, is trying to flesh through what areas of the market to invest in versus what are these earnings saying about the real strength or weakness of the economy. Mike, your thoughts?
Yeah, the one sector that's been doing poorly on earnings is retail. Bed Bath & Beyond, I think, is either last night or this morning, and their stock is trading down. We saw Walmart trade down, 8-9%, not even on earnings, just on an announcement that they are working through very high inventory levels, discussions about foot traffic, and that they're having markdowns. Mm-hmm. Markdowns are disinflation. So there's another disinflationary signal for you. But other than retail, it seems like the market has been very forgiving. Again, Google and Microsoft are the two big examples. So, like you said,
I would even say that this morning. You're right. The market is being very forgiving. Facebook, Meta, whatever you want to call it these days, they had just absolutely atrocious earnings, and the stock's only going to trade down about $6 this morning. It's if they had these types of earnings in the first quarter, the stock would be down 20-25%.
Right. Their revenue declined for the first time ever. I mean, this is a growth company. You don't want to see revenues declining.
Well, it was a growth company. It's now a dead company.
Right, and it's also got a PE that's not so growthy anymore.
Exactly. Growthy. It's a new term. It's a new term.
Word.
Growthy.
Write that down.
It's a new Bushism for Michael Lebowitz.
Yeah, but I agree with you, Lance. I think Amazon and Apple will be important. And you know what? It's not necessarily the market reaction. It's what are they really saying?
Yeah.
That I think will be important, especially Amazon, because Amazon sells everything to everyone.
Right.
But going back to that Walmart versus Amazon, that's global. That's not just in the United States. And when I first, this was a chart that Lance and I both shared on Twitter. It's stunning how much bigger Walmart is than Amazon, and Amazon bigger than its next, competition. And I don't think Target was even in that top 10.
No, it wasn't. And it's just amazing. And what was it? One that did surprise me was in the top 10 was Kroger's, which is a domestic. That's only a U.S. company. And it's amazing how much, how many groceries they sell, domestically. And I guess this really goes to, portfolio strategery as we talk
Grocery and strategic.
Exactly.
Exactly.
So
cut them off, Brent.
Exactly. Look, it's that time of the morning. It's 5 minutes till the end of the show, so we can crash it now. Anyway, but yeah, I mean, this is going to be kind of the real conundrum for investors. And again, kind of joking about portfolio strategy, but this is going to be the problem. Is managing the portfolio through here. I mean, you can make a very good case why equities should continue to weaken over the course of this year and into next year, particularly as the economy does slow down more. But from a portfolio management standpoint, what we have to determine is when has all the bad news been priced in. And there's some early kind of evidence that after we saw stocks getting blasted by 20-25%, Netflix in the first quarter down 20% after they announced earnings. Amazon was hit sharply in the first quarter. They were down like 15-20% over the course of a couple of days after they reported earnings. Has all that bad news, virtually been priced in for a slowing consumer? And now we're starting to see these companies, again, as you said, report earnings that aren't as bad as expected, and that is kind of normally where stocks kind of start to find their footing. And that seems contrarian to this whole idea of, if you look at the media, like we're talking about recession and ongoing interest rates and all these type of things, but stocks tend to price in those issues before they actually bottom, and the market tends to lead, kind of the overall economic environment by 6 to 9 months. So, is the market starting to tell us that they've already priced in, the worst of the news? And, it's hard to imagine with stocks only down 17% from their peak that all the bad news has been priced in. But again, a lot of stocks are down a whole lot more.
Yeah, I think at the end of the day, this all comes down to inflation. The quicker inflation can get back down towards 2%, the quicker the Fed can go back to being the Fed that we all know and love. The Fed put becomes alive again, right? The Fed can't do what stock investors love about the Fed if inflation is at 5, 6, or even 9, 10% like it is now. But if you get inflation all the way back down, the Fed can be the market's friend again. But there is no there are indications, and it does appear that they're peaking, but right now inflation is still high, maybe peaking. The question is how quickly will it come off, and how quickly will the Fed get comfortable that it will get back down to their target. Mm-hmm. And I think at the end of the day, that's probably the most important thing we can follow.
All right. On that note, we will wrap it up for the day. 3 minutes on markets and money coming out here in just a minute. So we'll have the technical update for the markets and where we're trading this morning. Also, get by the website. Our newsletter will be out this weekend, so make sure you're subscribed for that. Simply just click on the newsletter banner right there on the homepage. You can subscribe. We have banners kind of all over the place. Subscribe. But there's actually a link on the front page right there at realinvestmentadvice.com, just below the latest newsletter banner. That just put your email address in. We'll email you the newsletter as soon as it's produced. We've got a new Bull Bear report coming out this weekend. So a market-centric, investing-centric newsletter. We've kind of changed the focus of our newsletter to be more specific to portfolio and investing. That's coming out, the first edition of that coming out this weekend. So make sure you're registered on the newsletter list for that. Daily market commentary. And of course, check out SimpleVisor, which is our full digital research platform. all at the website. It's amazing how much stuff is at realinvestmentadvice.com. You'll find it all there. Have a great day. See you back here tomorrow.
It's a rich man's world.